what we're going to do is we're going to start with the biggest company in the world. We're going to look at Apple. So we're going to go to my favorite website, which is the SEC's website. So all this gibberish may confuse you, but I'll quickly sort of show you what some of it means. An 8K is any disclosable event, basically. So any big news. And so what's disclosable? And this actually has been a topic in the news lately. So any kind of material means important, right? Any material event. And you'll get to know kind of what that concept is. So that's what the 8Ks are. A lot of these are kind of confusing. The 13G or D is an ownership statement. So if someone owns more than 5% of your company, that's what a 13G is. So all of these are specific kinds of statements. And the ones we're concerned with are the 10Qs and 10Ks. The 10Q is the quarterly earnings report, and the 10K is the annual report. So we use these, not only these, but we start off with these Form 10 filings as our important kind of things we're going to focus on. So anyway, let's see the most recent 10 filing. If you see it for yourself, it's the 1/27, January 27th, 2016 10Q. We're going to click Documents, and we're going to click the first link, which brings us to the 10Q. And this is Apple's earnings report. You could use the same procedure for looking up any public company's financial reports. So you can look up how much money Ford made last quarter, or how much revenue Pfizer had last year. You see the little Apple logo, and you see on page 2 and page 3, you can see what their sales were. So sales of $75 billion for the 3 months ended December 26, 2015. That's a lot. I think they're one of the highest revenue producing companies in the world, $75 billion. So what do we do with this information? How do we interpret it? We're going to use what I call the Holy Trinity, the income statement, the balance sheet, and the cash flow statement. And this is the income statement. And we're going to learn that well. And you can actually abbreviate it pretty easily as IS, BS, and CF. Income statement, balance sheet, and cash flow statement. And the three of them come together to sort of portray the results of a company for any given period. And you need all three to really interpret a company's performance. And all three kind of tell you slightly different information. We typically focus, especially as beginners, on the income statement and the balance sheet. The cash flow statement's a little bit advanced. It's still very important. Sometimes it's important, sometimes it isn't. But anyway, we're going to spend a lot of time on the income statement and the balance sheet, and we'll end up looking at the cash flow statement in future courses. So let's try to interpret the Apple income statement. What I like to do is I like to go to Excel, and like I said, I like to look at those 6 things first and foremost. So the stock price of Apple, so you don't really need to know the stock price any second. I think that's a big waste of time, in fact. So anyway, the stock price is about $97, and the number of shares Apple has is on the 10Q, and it's on the first page. It says right there, 5.5 billion shares of common stock as of January 8th. So I'm going to type in 5544.583, and that's for the fourth quarter, sort of corresponds with the end of the fourth quarter of 2015. And the market cap is obviously the product of the two. If you have something that you're splitting into any number of units, whether you're splitting a pizza pie into slices, and each slice, you have 10 slices and each slice is $10, well, the whole pizza costs $100, and that makes a lot of sense. The same thing with Apple. Apple has decided to split its company into 5.5 billion equal parts, and each part trades on the stock exchange right now for about $97. So all of the parts of Apple together cost about $537 billion, which makes it the most expensive or most valuable, good way to put it, most valuable company in the world. How much cash does Apple have? I saw someone tweet at me the other day. Well, where would we find that? We don't find that on the income statement. It's on the balance sheet. The balance sheet is literally the statement of balances. It's how much cash balance they have. It's how much debt balance they have. It's how much accounts receivable balance they have. It's how much balance on any given subject they might have. So anyway, we go to the balance sheet, and we see the first item is cash. And is that normal? Is that how this thing works? It is. The way balance sheet works, and this is sort of in the PowerPoint, is the way balance sheet works, it's listed in order of liquidity. What does that mean? Well, the most liquid thing, liquidity is just how fast can you convert it into cash. And cash is the most liquid thing. You can use cash to buy something. You can't use a house to buy something. You might have a $5 million house, but you can't buy groceries with it. The grocer will look at you and say, I don't want your house. I want $15 for these beers you're trying to have, Mr. Shkreli. I hate when that happens. But the liquidity is just conversion to cash. So cash comes first. And the next most liquid thing to cash is marketable securities that are cash-like. So things like treasury bonds, even some stocks and things like that are marketable securities. So if you had, let's say, a balance sheet of $5,000 of cash, $3,000 of marketable securities, well, what's next? Accounts receivable is next. So this is money that people owe your company for product that you've sold to them. So this is stuff like if Apple, who presumably they ship their computers or their devices to a company, let's say like AT&T, and they say, here's 15,000 iPhones, pay us within 30 days. And you may not realize as a beginner or someone who hasn't been in the business world that that's how business is done. You might think that's crazy because you can't go to the Gap and say, well, I'll just take these 30 sweaters and I'll just pay you when I can. That's not the way that it works at the Gap, but in real business, that is the way it works. Believe it or not, you usually pay within 30 to 60 days in American and most of international business. And that's called, we usually like to say net 30, and there's a discount for paying early, and there's all these accounts receivable terms. But what about sometimes when you have customers who don't pay? And that happens quite a bit. We call that bad debt. And accounts receivable is actually listed as net. So it's net of bad debt. And you have to estimate what you won't collect on, and literally what you have to send to accounts receivable, which is the collections agency. So anything after 60 days, typically, you would discount that in your accounts receivable. So if this company this sort of pretend company that I'm making up here, they might actually have $2,500 of receivables, but because some of that, maybe $500 of that is 90 days past due or 60 days past due, you'd start to like write it off of your balance sheet. You'd start to say, well, I'm not going to get that money from that customer, and hopefully you don't do business with that customer again, but you typically, or you sue them or something, but you typically have to write off the bad debt expense. Next is inventories. So inventories is pretty complicated, and we'll treat this over several lessons, but inventories is basically goods that you have that you're hoping to sell. And inventories can include all kinds of things like raw materials. Raw materials like if you're, I don't know, Apple, you might end up buying a lot of glass, then that's a raw material. And you're going to turn that glass into an iPhone, but it's certainly not an iPhone when you buy the glass. And you're buying this raw material and you're converting it into your finished product. So you have raw materials and finished products. So of course, Apple has iPhones sitting there on the shelf waiting to be sold. Those are finished products. And then in between, they have something called WIP, which we call work in progress. And that's like a half-finished iPhone or something like that. So after inventories, we get into all kinds of crazy other assets. And the most important one, we're going to call PP&E, property, plant, and equipment. And this is going to end up playing a huge role in finance. So just keep this in the back of your mind. Property, plant, and equipment is any hard asset. It's any hard asset which has a useful life of more than what? It has to be a useful life of 12 months. So any building, any land, for instance, property, plant, and equipment, any factory, like if you bought a machine like I don't know, some kind of, if you're in Apple, I guess, some kind of widget that makes iPhones, a big factory machine that, I don't know, puts the iPhone together, that costs you $20 million to make. That's plant. That's literally property, plant, and equipment. And that's a really important part when it comes to accounting. It turns out to be extremely vexing in how we deal with it, and tricky and quite important. So any good that is going to have its utility, it will be measured in more than 1 year. A paperclip doesn't have utility more than a year. A paperclip is, you use it when you use it. But even computer software, if you buy a 5-year license for computer software, you could actually have a useful life of 5 years. And the way you account for that expense is very tricky. And it turns out there's a lot of accounting questions and even sometimes accounting fraud that occurs when you misaccount for how a useful life of an asset is. So property, plant, and equipment are very important in business, and we'll talk all about it. So we have other assets, things like that. And the point is that as we go down on the balance sheet, We, of course, add this all up to get to total assets. We get a sum here of total assets. But as we go down the balance sheet, it becomes less and less liquid. Cash, extremely liquid. Marketable securities, it's not quite cash. I can't go to the grocery store and say, here's some treasury bonds. Will you sell me a Snickers bar? They would say, well, maybe you should sell your treasury bonds and then you can buy the Snickers bar. And you say, but I don't know, Miss Cashier, this treasury bond is very liquid. You'd still say, no dice. You have to go sell that treasury bond first. Accounts receivable, well, that's not even money that you have in your hand. At least marketable securities, you've got something. Accounts receivable is a promise from your customers to send you cash. So that's really not liquid. In inventories is not even accounts receivable yet. That's stuff that you hope to sell. And then when you sell it, you hope to collect. So inventories is even less liquid. And PP&E is the least liquid of them all, where it's just property, plant, and equipment that you use to make the inventories, which you use to get the accounts receivable, which you use to get the cash. So hopefully it makes sense that this is an order of liquidity. And then finally, we have things like goodwill and intellectual property and we call these intangible assets, like your brand. An intangible asset will never actually convert itself to cash, right? Your patents won't actually become cash. They're just patents that protect your ability to do business, your brand name, your trademarks, all those things. So anyway, that's sort of what the asset side, these are assets. Goodwill is often, it's the entities you've purchased, it's a technical accounting rule, and we'll talk about that at some point. Okay, so let's look at the Apple balance sheet. So we just did our own mini review of a balance sheet. So let's look at Apple's. All right, so current assets. These are assets that are convertible to cash within 1 year. Everything other than that is going to take more than a year. So cash and equivalents, 16 billion. Short-term marketable securities, 21 billion. Does anyone not see this? So I'm just going to add this up. Current cash of Apple is 16,689 plus 21,385. That's $38 billion. That's a lot of cash to have burning a hole in your pocket. How much accounts receivable do they have, guys? 12 billion, 953 million. Yeah, so that's a lot of money that their customers owe them, right? Isn't that kind of crazy? Could you imagine? I get angry when someone owes me 20 bucks. Let alone, my customers owe me $12 billion as of December 26, 2015. Isn't that crazy? And the world works that way. That's how Apple does business. That's how every company does business. We're just going to ship. We're going to ship out our product, and hopefully our customers will pay us. If they don't pay us, of course, we have rights. We can sue them. We won't do business with them together. So that's how business is done. And it takes some getting used to, the idea that, you're going to do this on faith. And you can see that Apple, again, $13 billion that it's got out there to its customers. Its customers are probably companies like AT&T and Verizon. They're probably companies like, retailers that buy their computers and then hope to resell them later, things like that. Okay, so they have $2 billion in inventories. Obviously, accounts receivable, which I'll just say AR quite a bit here. AR. Accounts receivable and inventories are not cash. Here's a different receivable, vendor non-trade receivables. What do you guys think that is? It's money that's owed to them. It's not from product they're selling. It's from vendors. Yeah, it could be patent rights. Who knows? Well, oftentimes you'll see these weird lines and we'll want to look them up. We'll want to look them up in the financial statement. So we'll see what that means shortly. All right, other current assets. This could be anything. This could be, like, for instance, if you pay your rent for January, in December you have to book that as an asset that you've prepaid an expense. If you paid Microsoft for a 1-year license ahead of time for some software, for Office software, you actually have to put those in your balance sheet as an asset. So other current assets, I'll just call it OCA from time to time. And the total current assets, these are all assets that you expect to be cash or converted to cash within 1 year, 12 months, is $76 billion for Apple. What's next? Long-term marketable securities. So this is super interesting. They have $177 billion of this stuff. I'm going to add it to the cash balance that I'm keeping tally of here as my top 6 things that I like to look at when I look at any security. Why do you think I'm doing that, guys who are students? Why do I think that these long-term marketable securities are cash? You could sell them. You could trade them for cash pretty easily. Their value may fluctuate, but you could certainly trade them in for cash. Now, why are they long-term securities? Why is there one that's a long-term marketable security, and then there's in the balance sheet, you can see there's one that says short-term marketable security? What's the difference? Yeah, these are stocks or bonds that they own. So typically it's their bonds. Most corporations don't want to hold stocks, right, on their balance sheet. You know, they're not hedge funds, including Apple. They like to own bonds. Bonds are safer typically than stocks. And so the reason that the way bonds work is there's a maturity date. Bonds are borrowings. So the maturity date is by a certain time frame. Most of the time, big corporations like Apple, they don't even want to own corporate bonds. They want to own government bonds because those are even safer. So what ends up happening is if you have 2025 American US Treasury government bonds, what you end up having is that's a long-term security because the government doesn't have to pay you back until 2025. Now you can always sell that bond, so it's still liquid, but it's a long-term marketable security because it won't get paid back for 12 months or more. So it's a little confusing. That's why I just add it all up. I take the cash of 16 billion, the short-term securities of 21 billion, and the long-term securities of 177 billion. I add it all up and I just say, you know what, that's all cash to me. It's about 215 billion worth of cash. And they can separate it and slice it and dice it all they want. But at the end of the day, this is basically cash to me. So what's next? Property, plant, and equipment, $22 billion. This is literally stuff that's as complicated as, like I said, semiconductor fabrication equipment, where they create semiconductor wafers, all the way to something as mundane as an office chair. An office chair is going to last longer than a year, hopefully, if I'm sitting on it. You'll have to value that over the course of several years. So that's just something to kind of think through. Goodwill and intangible assets. These are kind of the accounting gobbledygook that I encourage you to ignore for now. You'll learn more about goodwill and acquired intangible assets later, but there's about 8 billion or 9 billion of that here. And then other non-current assets. You see they have OCA, other current assets, and they have other non-current assets, ONCA. And these are, again, miscellaneous. So we looked at the assets, and if you total all of them, it's about $293 billion of assets. $293 billion of assets. And now, quickly, in your mind, you might want to look at the market value of Apple and say, it's a $500 billion company, and it has $293 billion of assets. How does that make sense?
Does it have to do with what people speculate their value is going to be like at a certain point in time?
Absolutely. Absolutely. Yeah, those are the values today. But clearly the company will make multiples of cash over the next several decades. All right, so what about liabilities? Well, liabilities are a little easier than assets. Let's look at a few of these. So the first liability is accounts payable. The most dreaded liability, and I'll just abbreviate it A/P, but it's accounts payable. What's accounts payable? Do you guys know?
That's what you have to pay out or what you owe.
Yeah, it's the opposite of accounts receivable. Your accounts payable is somebody else's accounts receivable, right? So a good example is one of the biggest accounts payable for all of corporate America is law firms. So if you go to your favorite law firm, Maduri Thompson, LLP. I need your legal services because I need to sell a bunch of Apple computers, and I don't know how to do it. So why don't you guys assist me and advise me on how to sell these Apple computers to AT&T for $25 billion. You say, all right, here's the legal services, and then you send a bill. And you invoice Apple, and you say, all right, Apple, you owe me $25,000 for those legal advice. And Apple says, okay, we'll pay you within 30 days. Well, that's an accounts payable. When between day 0 and day 30, by the time you write the check, that's an accounts payable. You have to have it on your balance sheet. It's kind of like a debt in that you have to pay it, but it's not really a financial obligation in the sense that you ever borrowed the money. It's accounts payable for a good or a service. Another example of accounts payable is your rent or whatever it might be. Accrued expenses. So the difference between accounts payable and accrued expenses is pretty subtle, and I won't belabor it. But think of accrued expenses as simply expenses that perhaps that you are going to have to pay. And again, we'll talk about accruals and things like that. This is not an accounting class, but we'll definitely have to talk about accruing an expense over time. For example, if you have a contract with somebody. Let's say you had a contract with an employee to pay that employee $1 million a year. Well, your accounts payable is only going to be every paycheck, individual paycheck for that employee. But your accrued expense could be the whole $1 million. So that's one way to think about an accrued expense. But think of both accounts payable and accrued expenses as basically just cash that you've got, funds that you're going to have to pay for running your business. Deferred revenue. This is one of the most complicated. Deferred revenue is literally cash you've gotten, but you haven't given the product out yet. I know some people in this chat would love to be in that situation. Most businesses don't operate this way, but sometimes in contracts you do get cash up front. So gift cards, great example. All kinds of unearned revenue, and that's what deferred revenue is. You get cash and then you have to deliver the product. And in software, you end up getting a lot of deferred revenue for some reason. Commercial paper, that is debt. There's just like there's a bunch of different kinds of cash, there's a bunch of different kinds of debt. Commercial paper is literally loans from banks and things like that. Debt is debt sold to the debt markets. So all of this is money we borrowed, basically. If you look at all the debt that Apple's borrowed, I'm going to start with the current, I'm going to start with commercial paper. There's 7.3 billion of that. I'm going to go to Excel and put that in here. 7259. They've got current portion of long-term debt, 2.5 billion. And then they have long-term debt of $53,204,000,000. So there you have it. Apple has 215 of cash and 62 of debt. So the enterprise value is what? 385 roughly. So the value of Apple, the business, is actually 385 billion, even though the market cap is 530 billion. Why is that? The company has $150 billion of net cash. So if the company is trading for 530 billion, but inside that company is 150 billion of cash, when you're paying 580 billion for it, or maybe you're buying a fraction of Apple, which is more likely and reasonable to assume, every time you buy a share of Apple, you're literally buying, for every share, you're getting a small portion of cash, right? You're buying not only the computer company, but you're also buying the cash that the computer company has and the debt they have. And if you subtract the cash from the debt, it's about 150 billion. But the market cap is 530 billion. So literally a third of the company, or 30% almost of the company, is just the cash on the balance sheet. So you have to sort of cancel that out. Because if you had a company, let's say, for argument's sake, Apple had 500 billion of cash, what would be wrong with that picture if the stock was trading for a 500 billion market cap? You could buy the whole company, or even a part of the company, for 500 billion. And they already had 500 billion in cash. That would mean that the business, you're getting the business totally for free. I don't know if you have a better way to explain it.
Oh, okay.
And right now, the way it works for Apple is the whole business is worth 550 billion, but they have about 150 billion in cash. So it's not quite all for free, but it's a good portion for free. It's it's worth noting, right? And you'll see that when we value companies based on earnings and things like that, we have to think about the non-cash portion of the business. So we're going to have to look at that carefully. And of course, it affects you if you're just buying shares and not the whole company. You very rarely buy a whole company. That's private equity. But it still matters when you are buying shares of a company, even if you're buying a small number of shares of the company. You want to know how much cash the company has. Because think about this. Let's say you did have a company, let's make up a new company. A company that has 50 million market cap and 60 million in cash. So Apple's got 500 billion and 150 billion in cash. So it's not free, but it's about a third off if you think of it that way. And we'll look at this in more and more detail later. Okay, so let's look at Apple some more. The balance sheet has total liabilities of 165 billion. So compared to assets are about 300 billion, liabilities is about 160 billion, so shareholders' equity is 130 billion. Does anyone know what another name for shareholders' equity is? Book value. Book value. So it's called book value because it's literally the value of the company in many ways. At assets, if you subtract liabilities from assets, or you just say assets minus liabilities, you kind of have the value of the company in some ways, right? Sort of makes sense. If you have the assets of the companies and you subtract out the liabilities of the company, assets minus liabilities, you have kind of what's left over is shareholder equity, or sometimes we call that book value, right? Because if you had a company, let's say, that was going out of business tomorrow, and you said, all right, how much assets does the company have? Well, it's got, let's say, $500,000 of assets, and it's got $100,000 of liabilities. Well, after you take care of all the liabilities, you pay off all the debts that the company owes before it winds down, you'll be left with $400,000, right? That makes sense. Shareholders' equity or book value of $400,000. Now, some of these assets are intangible, right? Like goodwill and patents. The patents aren't going to be worth anything when the company's out of business. So you got to just look at the hard assets or the tangible assets. And you can do something called a tangible book value if you wanted to remove some of those pesky goodwill and intangible assets. So anyway, that's the basic crux of a balance sheet, is the assets minus the liabilities will equal the shareholders' equity. And if you know your algebra, you could add liabilities to both sides, and you can see that assets will always equal liabilities plus shareholders' equity. That's because a balance sheet balances. That's the concept. It has to balance on both sides. And we'll learn more about this if we ever kind of look into accounting. But this is sort of the basic gist of a balance sheet. And I think we did a good job of looking at it. Now we're going to look at the income statement, the second in the Holy Trinity. And this is going to be a little bit more fun. This is going to kind of really make more sense. A balance sheet has a lot to do with accounting. And accounting is a little bit dry, needless to say. And it's a little more abstract. But when we deal with the income statement, we can really see kind of the reality before our eyes. So you can see here the Apple income statement. And you can see that they had $75 billion of revenue in Q4 2015. Q4 is the last 3 months. So that's October, November, December. In just 3 months, they generated $75 billion of revenue. What is revenue? Revenue is just sales. Revenue, sales, turnover, receipts, they all mean the same thing. We'll worry about costs and profits in a second. But when it comes to revenue, how do you know something is revenue? Obviously, if it's a retailer, right? When you sell the sweater and you get cash for the sweater, you understand that's revenue for sure. But can revenue be more complicated than that? What if your law firm, right? You said, you gave us an invoice for $50,000 and I said, wait a second, I only used $40,000 of resources. How much revenue should you book? And what if I told you I'm not going to pay you for 60 days? Is it revenue still? All of these questions are actually pretty important. And recognizing revenue is actually pretty difficult. And we call it revenue recognition. And sometimes, if you're really fancy in business, we call it RevRec. RevRec. And obviously, RevRec is simple in some businesses and not so simple in other businesses. And in general, the kind of idea for when you recognize revenue. When do you recognize revenue? Typically, it's when, and this is a general rule, it doesn't always apply, but in general, it's when what? It's when title to the product has passed.
So someone else owns the asset, whatever it is.
Yes, exactly. So even if it's on a promise. So a lot of revenue you don't actually have to have received the cash. Mm-hmm. So it's actually, a promise is good enough. So you can book revenue on just a promise. There's a lot of other rules. Like you obviously can't sell your product to another part of your own business, right? You have to net that out. That's called intercompany revenue. And it happens sometimes, and there's nothing wrong with it, but you have to take it out. Intercompany revenue gets canceled. And a lot of accounting fraud, I think a bunch of internet companies had this as a fraud, Enron had this as a fraud, is when if you're selling to your own company, you can often overinflate your revenue. Then there's things like, what if you have a contract over 4 years and someone gives you all of the cash up front? Let's use that example. Let's say you have a $10 million contract with Boost Mobile, and you have a $10 million contract with Boost Mobile to promote Boost Mobile products for 4 years. And it comes time for Q1 2016 in revenue. How much do you report? And Boost Mobile gives you a check for $10 million. $2.5 million? or do you report 750,000? There's specific rules, and it's called FASB, and you report $750,000. FASB is Financial Accounting Standards Board. And again, accountants need to know this, but if you're going to be an investor, you need to know some of this stuff too. Accounting is a language of business, and you have to know the language of business. And 10 million is the cash you get. Sure, you get all the cash, but your revenue is only $750,000, and you'll report that every quarter for the next 4 years, for 16 quarters. Your balance sheet will have the 10 million on it right away. But then that's when you have deferred revenue. So what you'd end up having is you'd have revenue of $750,000 every quarter. And on the balance sheet, this is the income statement. On the balance sheet, you would have deferred revenue of $9,250,000 because you still have to you've collected the 10 million, your cash will be 10 million. But you haven't performed $9.25 million of services, because you can bet that if 𝗕𝗢𝗄𝐳𝐷 stops rapping about Boost Mobile 1 quarter into his 4-quarter deal, Boost Mobile will sue him. So he's got to carry that deferred revenue and write it off every quarter for the next 16 quarters or 15 quarters. So anyway, that's how sort of revenue recognition can be pretty tricky. Obviously, if Apple sells $10 billion of iPhones to AT&T, it's relatively simple, but believe it or not, it can still be complicated. For instance, returns. What about returns? Return policy is a huge part of revenue recognition. Oftentimes, companies like Apple will have a return policy. So they'll say, you know what, AT&T, if you return us any of your phones, we'll give you your money back for the phones that you return. And some companies have no return policy. It really depends on your company. But a return policy is somewhat common, and you have to reserve revenue for return policies and all kinds of things like that. So anyway, there's a lot of complexity to revenue recognition. It may seem really simple, but sales are not as simple. All right, so next we have something called COGS, or cost of goods sold. COGS, cost of goods sold, is the cost to make the revenue. So it's literally cost of revenue. So if they sold $75 billion, right, of phones and iTunes and all these things, it cost them $45 billion to make that stuff. So they have a margin left over, and that's called the gross margin. Gross margin. And you can see, I'm not going to type in, if you look at this closely, I'm not going to type in 30423. I'm actually just going to subtract cell F3 and cell F4. Subtract cell F4 from F3, and I get 30,423,000, because that is the gross margin. So they sold $76 billion of products in Q4. That means they might have gotten cash for some of that. They might have not gotten cash for some of that, but they pushed out $75 billion of their products to the world, whether that they got paid right away or didn't get paid right away. And it cost them $45 billion to make that stuff. So it cost them money to buy the glass and the equipment, all the stuff that goes into one of these things. And you can see that they made, if you think about it, they made about half. They made about 50%. For every dollar they sold, it cost them about 50 cents to produce those goods. So if we actually just do this, we can do gross profit or gross margin percentage. We'll call this gross profit, and we can do the formula. Does anyone know what the formula is?
It's your total sales, the revenue minus your COGS.
No. So that's what gross profit is. As a percentage, gross profit divided by revenue is 40%. And we got a great question from Dan Van Glam. Does it include labor? Yes, it does. Yes, it does. According to GAAP, generally accepted accounting principles, which are promulgated by FASB, the Financial Accounting and Standards Board, any cost of the product, whether it's the raw materials, even the plant, operating the plant, the person that works at the plant that maybe is the plant manager but doesn't actually make any of the goods, that's still a cost of goods sold, usually. So where the costs go into what bucket is sometimes unclear. Obviously, the cost of all the equipment and things like that will go into the COGS, and we're going to worry about depreciation and things like that later. Those will be very complicated. So what we end up with is they sold $75 billion of goods, and we're going to keep chipping away at that until we get a profit line at the end. And the first thing we're going to chip away is the cost of making the products themselves. So after we got $75 billion in the door, is one way to think about it, we're down to $30 billion of profit left over. So what's the next expense? This is accounting. This is an income statement. This is the income statement. So we're trying to figure out what our income is at the end of the day. But there's more expenses than just the products themselves, so what they cost. There's research and development. Apple has a bunch of smart guys sitting around and thinking about how to make new products. They only spent $2 billion on that stuff. Isn't that interesting? Think about how much profit they have. $30 billion, right? And they spent only $2 billion. $2 billion on research. And how about marketing? Selling, general, administrative. So that's not just marketing. That's the CEO's salary, Tim Cook. That's their office building. That's all kinds of other things. That's their legal expenses. That's only about $4 billion. So they're a really profitable company. After their cost to make the stuff, they barely spend any money on these other things. So we're going to call these operating expenses. Operating expenses. This is what it costs to run Apple, about $6 billion. $45 billion to actually make the products, but $6 billion to actually run the company. So operating profit is kind of what's left over. And this is an important line. Operating profit is kind of gross profit minus operating expenses. So now we're down to $24 billion. So revenue was $75 billion in Q4 15, and now operating profit is $24 billion. So we can actually do an operating margin. Operating margin. And that operating margin is roughly 32%. That's a very high margin. Most businesses don't have a 32% operating margin. Some pharmaceutical companies do, but retailers and things like that have more like 10% operating margins. So pretty healthy margins from Apple. What's left after operating profit? What other expenses could there be? It's going to be a lot of financial and taxation kind of expenses. So that's the only thing separating us between operating profit and what we call net profit. Net profit. So taxes is a huge part of that. And interest on all that cash they've got, right? They get $402 million of just interest. So we call that pre-tax income, and then there's finally taxes, which are what you think they might be. And again, taxes aren't necessarily cash they've spent. That's just cash that they're going to spend often. And what we're left with is $18 billion. So we can calculate again a net margin percentage. 18 billion left over after 75 billion of revenue. So 24 cents. Every dollar that Apple gets from you, they keep 24 cents. They can also calculate a tax rate. What does Apple pay in taxes? Well, they're making 24 billion before taxes. They spent 6 billion on taxes, so 6 divided by 24 is 25%. How about that? Apple pays double or triple the tax, or we all pay double or triple the tax that Apple pays, even though Apple is a corporation. So that's what a lot of people don't like about corporate America. 25% tax rate, that's pretty low. And then we can think about it on a per share basis. So what's the income per share or earnings per share, EPS? Well, we have to write down how many shares there are. There are 5,594,127 shares. So the earnings per share is $3.28. Okay, so that's sort of Apple's income statement for Q4. In Q4, you can see they gave you this year's quarter and then last year's quarter. So what we can do is we can actually take all of this, copy it, and paste it, and the formulas all come over. So what we can do is we can just quickly type in all the numbers from last year, and the formulas are all there, so everything automatically updates. So it's super fast to just quickly update all of it, because it's all the same format. And we can see that the final number is the same, 18024, 18024. And we can copy and paste all of these. So it's pretty easy. And now we can even compare revenue increases year over year. And this is a big problem for Apple. If you look at Q4 of 2015 divided by Q4 of 2014, revenue only increased by 2%. And the way you can figure that out is the simple quotient of new divided by old. New divided by old minus 1 expressed as a percentage will give you a change from new in new from old. So you can see Apple's revenue isn't growing anymore. And I wonder why that is. It could be because they haven't released a new product. It could be because they're just slowing down in general. Who knows? But it's definitely a worrisome trend, and we'd have to ask Apple why that's happening. Maybe people are already talking about it. But that's how an income statement looks for Apple. We can also type in the balance sheet very quickly if we wanted. So we're going to have to pay attention to that as well. So we did cash. So just do this super fast one more time. And I'm happy to take questions as they come up. You know, it's very important to know kind of what what exactly is this company's profile? What's their margin profile, for instance? Are they the kind of company that loses money? Are they the kind of company that makes money? Are they the kind of company that makes a lot of money? What's the relative amounts, especially as we compare them to other companies like IBM or Hewlett-Packard or other computer makers, phone makers like Samsung. We want to be able to compare them and say, why does Apple do so much better than these companies or whatever? So anyway, right now, we're not totally concerned yet with kind of what, thinking about what to look at yet.